Good evening, everyone. Welcome to our University of Virginia Alumni Homebuyer Workshop. My name is Jason Maida. Sorry for the little bit of the delay. We had a little bit of a technical issue. Of course, that happens with the first workshop of 2025. We got to kind of make a few little adjustments. Thank you so much for bearing with us. I'm excited to bring this content to you. This is the first of 4 installments in our partnership with the UVA Alumni Workshop. And really glad you guys got a chance to hang out with us and learn a little bit more about homeownership as we're starting the new year. And it's actually a really great time to kind of have these conversations because, many of you probably are, maybe sitting down, maybe thinking about goals for 2025. Maybe that's budgeting for 2025, and perhaps homeownership is a part of that. So, I think attending a class like this will hopefully give you a nice little opportunity of what this could look like for you to pursue the path of homeownership. Now, this is a very interactive class. We encourage questions as we go through tonight's content. Our runtime will take us up just to about the top of the hour, but during that hour, we'll get a chance to weave in questions that come from our audience. A little bit about me. I will be your presenter this evening. Ken Fleck, who is also part of this presentation today, he's going to be answering questions that come through the chat or Q&A within Zoom, and so we'll be kind of monitoring those as we go through tonight's content. American Pacific Mortgage is a nationwide lender, and we're really excited to be in our next year of partnership with UVA, and it's been a very fruitful relationship for us. I can't, looking back now, we've got a chance to help several people purchase homes in 2024. Those were fellow alum that attended classes just like this throughout last year and then decided to take those next steps in homeownership, which you're going to learn a little bit more about in tonight's class. Well, tonight's class agenda looks a little bit like this. We're going to talk a little bit about the housing market, what's kind of going on with the housing market, both from a price perspective, but also take a look at interest rates and what's going on with interest rates. That's a big discussion right now for a lot of our clients that are active in the buying process. I do want to also walk you through a budgeting exercise, which will basically look at what does it look like if I continue to rent today, but what could it look like if I decide to purchase down the road? And then from there, we're going to talk a little bit about credit and making sure our credit's in the best possible position to prepare for home buying. We'll spend some time looking at student loans and how those could potentially impact us in terms of eligibility, various loan programs that are available to you as first-time or even second or third-time buyers. We'll also spend some time looking at some documentation. So if I'm thinking about starting this path towards home ownership, what items should I start gathering from home? What files do I need to upload? And then finally, we'll take a look at the buying process. So we're going to talk about, where do I go from here? So after attending tonight's class, how do I start that path towards home ownership? What will the steps of home buying look like? So I'm going to walk you through our 6 steps of home buying this evening, and then we'll wrap up tonight's discussion, taking any other questions that you have from the audience. Now, tonight's class is going to be recorded, so if you get a chance, if you miss anything that we talk about tonight, it'll be up on our YouTube channel tomorrow. We're also going to send out the presentation material to you tomorrow morning, along with the link to the YouTube channel. You can go back and review some of your notes from tonight's discussion. All right, so let's talk a little bit about buying. And I think about, when we're considering buying and as we launch into our home buying workshop, there's a lot of great benefits that come along with owning a home. When we're thinking about this major financial investment, it's probably going to be one of the biggest financial decisions you decide to make. And there's a lot of great benefits that come along with owning a home. When we think about home ownership, we create the opportunity to create stability in our housing budget. So when I renew my lease, today I'm having to worry about, is my landlord going to increase rents? What's going to happen? Do I have to find a new place to live at? But as a homeowner, I have the opportunity to kind of control my monthly budget when it comes to my housing expense. Now, this is an asset that should hopefully grow over time. That appreciation in your home value leads to home equity, and home equity which is probably one of the number one assets that we have in our portfolio, so to speak. So homeownership is a big part of that. And as this asset continues to grow over time, this is an asset you can potentially pass along to maybe heirs of your estate. And believe it or not, there's still some great tax benefits that come along with owning a home. And so when we kind of bundle that all into thinking about home ownership, this is a great opportunity to consider whether it's this year or down the road. And so we want to kind of help prepare you on that path towards home ownership. But before I think we get too far along in tonight's class, I think it's really important to, first of all, start with a budget. And, as I mentioned, as we launched in tonight's class, building a budget starting the new year is always a great kind of launch into the year. And when we think about it from a home ownership perspective, I want to kind of walk you through this calculator. It's called our rent versus buying calculator, which essentially takes a look at a scenario that if I continue to rent, doing what I'm doing right now, how does that compare to making the decision to purchase a home? So let's kind of dive into it. I just kind of switched our screen share over to the Freddie Mac calculator, which kind of shows us, what this looks like. And as I mentioned, we're going to send out the presentation material to you tomorrow morning. So feel free to walk yourself through this exercise on your own. I think it'd be super enlightening as you're kind of figuring out what homeownership could be for you. Well, let's take a look at this. And we've kind of just for time purposes, pre-filled in some of the data points here on this calculator. And the first thing is around monthly rent. So if I was a client and I had, let's say, a monthly expenditure of $2,500 a month, we input that there. We assume $15 a month in renter's insurance. And then we have the assumption that our rent will go up 4% on an annualized basis. All right. So that's in our rental section. We have a hard time with okay. Okay, let me just see sorry about that. I'd click our screen share. Okay, there we go. Okay, we should be good now. Sorry, it looks like we had a little bit of a technical snag there. So we should be on the screen share now. And so let me kind of just do a quick little backtrack on what I was describing to you. So if we go under this rental tab here, we have the $2,500 a month in rent. We have $15 on the renter's insurance, and then we have proposed or assumptive rental increases of 4%. Okay. And then under the home purchase side of things, then we're going to compare this to purchasing a home for $450,000. We're going to learn a little bit about loan programs tonight, but the minimum down payment for a first-time buyer is 3%. So we'll kind of talk through that in just a few minutes. We also factor in property taxes for my home purchase. We have homeowners insurance, which will vary based upon where we're at in the country. We'll talk through that a little bit too when we talk about loan programs. Homeowners insurance tends to be a very big topic, especially in higher cost markets like California, Texas, some of our eastern states like New York. But homeowners insurance is part of the budget. Maintenance costs is what we want to bake into our equation as well. And then under the loan informations tab, we assume that we're going to have a 30-year fixed mortgage. So most of our first-time buyers are going to elect a 30-year mortgage. We have average interest rate, which is hovering around the 7% level. Origination charges for your financing. So these all fall under the umbrella of closing costs. So when we purchase a home, we have closing costs, which will include lender cost, some of the title fees, escrow fees, maybe attorney fees, as well as any type of local or county fees that you have in your transaction. Now, we always suggest first-time buyers budget about 2 to 3% of their overall estimated purchase price for these costs. Now, inside of that, you will have origination charges from your lender. Now, one of the cool things with us in our partnership with the UVA alumni, we actually discount our origination charges up to $750 to help make that a little bit more affordable for our home buyers. Now, discount points is the next line item here. Now, discount points are where you as a buyer can pay additional funds out of pocket in order to bring down that interest rate. Usually one discount point is the equivalent of 1% of my total loan amount. And that one discount point should bring down my interest rate about 0.25%. All right. And then so when we look at the discount point opportunity, it doesn't necessarily make a lot of sense in today's market because most of our clients that are purchasing in today's market are probably going to consider refinancing in the next 18 to 24 months. So if I'm deciding to purchase in the 2025 housing market, rates are at 7%. Do I want to necessarily make investments to buy down my interest rate in today's market when I'm going to turn around and maybe refinance in 18 to 24 months? Probably not. So that's where we would want to maybe reconsider any type of additional cost options like that. And then we also have other settlement services that are noted here. And then finally, the next kind of section is other assumptions. So we're going to assume that our home will appreciate about 3% on an annualized basis, that I'm going to be in my home for the next 7 years. And then that when I eventually sell my home in 7 years, the cost of selling my home would be an approximate number of 10% of the purchase or the sales price. We have state and federal tax rates that will plug into the equation, and then finally a savings rate. So when we kind of look at the side-by-side comparison, if you will, we look at it from this perspective here. So we take a look at our total cost opportunity over 7 years, which by renting, we're going to essentially pay about $229,000 in rent over 7 years. But if I compare that to my cost opportunity of owning, when I factor in appreciation, potential tax benefits, we're closer to $169,000. So the delta in those two numbers is $59,000. So if I make the choice of buying versus renting over the course of 7 years, that's where I have about a $59,000 opportunity. Now, everybody's situation is a little bit different. As I mentioned earlier, I would encourage it. Take the time to dive into this calculator yourself. I think it would be super helpful just to get a better understanding of really what this could look like for you on that path towards homeownership. Okay, and so that's our rent versus buying calculator. And as we kind of move along in our discussion tonight, let's talk a little bit about the housing market. And, I get a lot of questions about, what's going to happen with the housing market. Obviously, as a country, we have a new administration taking over. So how does that impact the housing market? Does it impact interest rates? Obviously, we don't really know what's going to happen at this point, but we can kind of look at what's the trends look like in the housing market today. Now, we're going to spotlight just the Virginia housing market today. I do realize we have those of you in other markets here in today's session. So, in fact, if you get a moment, just drop in the chat kind of where you're joining us from, because we can kind of comment maybe on some other markets outside of the Virginia market. But I will say most markets have very similar trends in it, especially this time of year, because right now we're typically in the slower times of the housing market year, the cycle. Generally, we see the housing market pick up when the weather gets a little bit better, right? So, really around the spring months, we start to see housing market pick up, activity levels pick up. What's interesting, though, is this time of year has actually been really busy for us. And I think it's just because there's a little bit of an unknown, and some buyers just want to get into the market and kind of beat the spring buyers to the market, so to speak. And so I think our market's kind of feeling that. I know that in some of our high cost of living markets like California, for example, we are seeing a pretty high level of buyer activity. Now let's take a look at some of the trends in market for Virginia. So median sales price, just about 450 or 444 to be exact. When we kind of look at this over the last 3 years, pretty level, especially over the course of 2024. Average days on market, basically how long is the home staying on the market before an accepted offer is entered, is about a month. That changes, obviously, that cycles in some of our slower times of the year. But I do see, as I look in the housing market trends right now, again, more buyer activity happening. Interest rates, which are peaking as of late, are going to obviously drive buyer activity. But one of the challenges we have in the housing market right now is just the amount of supply that's in the market. There's not many current homeowners that are willing to put their homes on the market and trade off their 2.5% or 3% mortgages that they received back in 2021 or maybe the latter part of 2022. And so we have a little bit of a challenge when it comes to supply. Now, new home developments are starting to pop up. You probably see them in your local communities. But that's just not creating enough supply for us. So as buyer activity increases, supply is going to have to change, because ultimately, if it doesn't, then we will see prices start to elevate. And we start to see that obviously in today's market just in of itself. Some other higher cost of living markets are feeling kind of the pinch when it comes to sales prices. Well, when we look at interest rates over the last 12 months, interest rates especially is going to drive buyer activity. And, you've seen some commentary come out from the Federal Reserve about what they're doing with the federal funds rate. In fact, Jerome Powell they made the decision to cut the federal funds rate just before the holiday break, 0.25%. And the first thing we get from clients is, well, interest rates went down, right? Well, not exactly. And the reason why that is because we look in the details of the commentary from the Federal Reserve. We originally projected out 4 rate cuts over the course of 2025. But when we dig a little bit deeper, they actually made comment that they may only cut rates twice in 2025, and the markets just didn't like that. And you can see that's evidenced by kind of what this chart is showing us right here. So you can kind of see this blue line, which represents the 30-year fixed mortgage, starts pushing closer to that 7% level. Whereas just leading up to the commentary, we were probably in the 6.6 to 6.75 range. So as we push further into 2025, the question's going to be, well, where do interest rates go from here, right? I don't think we're going to see a lot of reduction from an interest rate perspective at this point. I think, originally our early forecast, if I was to look back in the middle of 2024, we were forecasting rates to hit 5.75 by the end of 2025. I don't know if that's necessarily going to be the case. I mean, we may stay in the high sixes as we move through 2025. But I think as we get closer into 2026 and 2027, I do believe we'll start to see rates start to kind of move more to a more of a historical level of, in the 5.5 to 5.25 range. Now, all interest rates aren't the same for all buyers. I think that's important to understand. There's various characteristics that go into the makeup of an interest rate. Credit eligibility plays a role. So whether I'm a 680 credit score or a 780 credit score, that could influence my interest rate. The type of product that I'm electing would change my interest rate. How much do I decide to finance? What does my down payment look like? So if I'm going to put 3% down versus 20% down, that interest rate might look a little bit different. We commented earlier about discount points where we can essentially pay additional funds out of pocket in order to bring down my interest rate. That is certainly an option that can help influence the interest rate. Just to go back to my earlier comments, though, I don't really think it makes a lot of sense to bring down interest rates with cost out of pocket because there's just not a really good return on investment on that. And then finally, the term of my loan can also influence the interest rate that I elect. Typically, a 15-year mortgage versus a 30-year mortgage will be a little bit less because short-term rates are just less expensive. In today's market, if you were to look at the 10-year and the 2-year Treasury, very closely aligned because really there isn't a huge benefit in short-term interest rates versus a long-term today. Typically, in high interest rate markets like we're facing today, you would see quite a big variance between those two levels. But in today's market, it's just not the case. All right, let me take a quick pause there. We're going to jump into credit in just a second. Before I do that, I do appreciate everyone kind of putting in the chat where they're joining us from. So, we're kind of all up and down the East Coast. We've got California representing, got Tennessee, Florida. So kind of a wide market. That's great. And that's helpful for me as your presenter because Virginia is one look at the market, but we also, we have other markets, like New York, Florida, and California that could look a little bit different. But any questions so far from our group here before we move into credit? I'm just checking out the chat. I think we're good there. And Ken's going to let me know if we got anything else there. Well, let's talk a little bit about credit. And, when I think about designing home buying plans for our clients across the country, there's usually kind of two challenges to home ownership. One, it could be I just don't have enough saved right now because I'm still working through student loan debt, or I just got to pay down debt, or I just started my new job and I just don't have a lot of resources. Or it could be on the credit side, whereas maybe I have too much debt, or I've had some legacy issues with delinquent credit, whatever the case may be. Those are things that we help try to solve for our clients. But I think it's important to understand a little bit more about credit. The good news is, many of us in today's call do already have great visibility to our credit score. You're using some of the tools that are available to you, and that's awesome. So when you decide to apply for a mortgage, it's not like you just randomly found out that you have a 720 credit score, right? But I think it's important to understand there's various credit score cards that are out there. There's a credit card score, which, of course, if you apply for a credit card, that's what they'll use. There's auto financing, and there's also the mortgage model. So those different model or different scorecards have different models attached to them. So your credit card models are going to be used for most of your monitoring services. So like if you guys are signed up for Credit Karma or one of the agency products, that'll all come through a credit card score. So I may have a 740 credit card score, but when I look at my mortgage score, maybe it's 750 or 720. So that's why you'll see a little bit of variance. Now, every loan program that's offered by a lender has various minimum credit score requirements, and you can see those on screen. So FHA loans, minimum 580, a conventional loan is 620, And then the VA for the veterans product is 620. So we're going to talk more about programs in just a bit, but I think it's important to understand that there is those minimum credit score requirements by product. Now, when we look at the mortgage credit score, there is weighting assessed to different areas of the credit report. 15% is going to be how long have I had credit. So the more mature my credit file is, the more seasoning I have in accounts, probably the better my credit score is going to be. 20% is going to be how much credit am I trying to get access to? Do I have new accounts that are recently opened? Do I have a lot of hard inquiries that appear on my credit report? That will impact 20% of the weighting. 30% is going to be looking specifically at revolving accounts. So looking at credit cards, personal lines of credit, home equity lines of credit. That 30% is going to be looking at the utilization or the ratio between your balance and your credit limit. And that's probably the biggest area of opportunity for most clients that I speak with on a daily basis. If I'm at $7,000 in credit balances and I have a $10,000 limit, then I'm at 70% utilization. So ideally, we do want to keep our balances at 10% or less of the credit limit. And I coming out of the holiday season, I totally understand that's probably not, doable for most of us. But I think as we are trying to bring down our debt levels and try to lower that percentage of balance to credit limit, the first stop would be getting to 50% utilization. So once I've gotten those credit cards to 5,000, feeling a little bit better, credit score starts coming up. Then once I get to 3,000 or 30%, the credit score starts to improve even more. But then once I get to 10%, I should be optimizing my credit score. And that's kind of the place we want to be. Doesn't mean every client has to be there, but if you're trying to get to the 800 plus level in credit scores, that's ideally where you'll want to have utilization of credit. And then finally, payment history is the last component, which is essentially how have I paid my bills over time. And if I've had some past challenges like a late payment, it's going to be rated as 30-day late, 60-day late, or a 90-day plus day delinquency. Now, generally speaking, late payments or any challenges I've had on my credit report in the last 12 to 24 months are going to be the most impacting of my credit score. Now, the further I get away from that date of the event, the better my credit score should start to improve. So if I had a late payment just in October of 24, well, that's pretty recent. So it's probably going to hurt my score a little bit more than as opposed to something that was back in October of 2020. Major events like bankruptcies, maybe collection accounts, those are going to have a bigger impact and lasting impact to your credit score. So just something to kind of keep in mind. On the lending side, we look at all three agencies' credit scores. So the three agencies are TransUnion, Experian, and then Equifax. So when we look at three scores from those agencies, we take the middle score of those three. So if my top score is 760, let's say my middle score is 740, and then my lowest score is 720. In qualifying for financing, I'm going to take the middle score, which is 740 for eligibility for our clients. It's not just looking at that credit score for eligibility for a product, but it can also influence, as we talked about earlier, interest rate. We're going to talk about mortgage insurance in just a bit. It can also impact all those items. So it's really important to try to get that credit score at optimal levels. Now, if I do have, let's say, a partner that's going to join me on my application, that's totally fine. When we look at the credit score situation, we're going to take the lowest middle credit score between both borrowers. So if I'm at 740 as my middle score, but my partner is at a 700 credit score, we have to go off the lowest credit score between both borrowers. All right. Any questions around credit that I can help answer for the group? All right. All right. So we're gonna kind of wrap up the credit section, and then we're gonna talk a little bit about student loans. And actually, we had a question that popped in. Let me just okay, cool. Okay, okay. There was a question that came in the Q&A, which was how do closing costs, origination costs differ, if at all, for first-time buyers versus buyers in general? So Origination costs, whether you're a first-time buyer or a second or third-time buyer, really shouldn't change, based upon your status, if you will. So that shouldn't have an influence there. As I mentioned earlier, with our UVA alumni discount, you'll have a discounted option with us, which lowers your origination cost by $750. But the cost structure shouldn't vary based upon what that status looks like. And then another question I got in the chat was just around, if my partner has bad credit, is it better to try to buy a loan? And that potentially could be an option. You may want to consider buying on your own if maybe your partner is not quite at an acceptable minimum credit score level. That's something I would encourage you to get connected with us for a consultation, and we can kind of strategize on seeing what makes the most sense. You're going to hear me talk a little bit about consultations later on, and how that next step looks like for you. But one of the things that we do a little bit different is that when you apply to our team, it's not like a pass or fail type of situation, meaning that if you, in that scenario, decide to apply with your partner and we run your partner's credit score and maybe it's at a 580 credit score, we can strategize together to see, like, A, how can we help bring up your partner's credit score? Or B, maybe we need to work on your partner's credit score on the sidelines right now, but then look at just qualifying you just in your name. Okay. Let's talk a little bit about student loans really quick. And so when we think about the student loan debt, we do have to kind of consider minimum payments for qualifying when we look at financing options. Now, some of us on today's call might be in forbearance for their student loans. You might be in deferment. Some of you might be even working on cancellation of student loan debt. Regardless of kind of where you're at in those stages, we do have to consider a minimum amount for the student loan debt. And it looks like this. So let's say, for example, I'm applying for a conventional loan and I have $75,000 in student loan debt. Either one, I can qualify with 1% of the balance, which would essentially be $750. Or if I'm on an income-based repayment program, let's say it's $250 a month, then we can use that $250 amount to qualify us for our mortgage. Now, if you're on an income-based repayment option, generally it's going to be much lower than 1%. So we always kind of encourage clients to have a payment program set up. But I have noticed, especially a lot of our federal student loan debt clients, they're not accepting new payment arrangements for student loans. So that's something we'll have to kind of navigate through. If you're electing an FHA loan, we can also still look at an income-based repayment option. But the difference between the 1% that's assessed automatically on a conventional loan versus a FHA loan, it's 0.5% of the total balance. All right, so all of that student loan information kind of falls into guidelines for specific loan programs. And so we're going to talk now a little bit about various loan programs that are available. We've kind of spotlighted 6 programs that are available to you. We could show you endless amounts of loan options, but I think, to give you a high level look at each one of these products is really important for you on that journey towards home ownership. So let's talk about the first one, which is a conventional loan. A conventional loan, when you think about the conventional product, falls under the Fannie Mae and Freddie Mac agency guidelines. You heard a lot about Fannie Mae and Freddie Mac during the housing crisis. That is the same Fannie Mae and Freddie Mac. They originate, or kind of have ownership, if you will, on about 60 to 70% of all originations done across the country. And so every year, right around October, November, Fannie Mae and Freddie Mac will release their conforming loan limit. It comes out once a year based upon essentially what the housing costs or the cost of living looks like. This year in 2024, it was raised to 806,500. So that's what we'll have for our new 2025 loan limit. But in high cost of living areas, like let's say we're in Alexandria, Virginia, you can go up to higher loan amounts like 1.2 million. Or if you're in California and you're going to buy in San Francisco, you could go to 1.2. Those are what we call high cost of living areas that we can adjust up a higher loan amount. But collectively across the country, the conforming loan limit is 806,500. That allows us at that conforming limit to go to a 3% down payment for first-time buyers. A minimum down payment, or a minimum credit score, I should say, for the conventional loan is 620. The next product is a government-backed or government-insured product called FHA. I know many of you have heard about it. That stands for the Federal Housing Administration. And then when you think about an FHA loan, it's not just for first-time buyers. It can be for second and third-time buyers. There's really no limitation around that. It does have a minimum down payment of 3.5%. Now you see a little bit of a difference in loan amount noted here on the presentation. So maximum loan amount in some of our Virginia markets is 524, 225. So in some markets, FHA doesn't necessarily align their loan limits to what we would see, let's say, with Fannie Mae and Freddie Mac. FHA does have a lower credit score requirement, so it goes down to a 580 credit score. Lot more flexibility in the guidelines that we'll see with FHA versus what we'll see around conventional. For our veterans that have VA home loan eligibility, there's the VA home loan product, allows a veteran to put zero money down to purchase a home. There really is no maximum loan amount per se. We have on screen $1 million plus, but essentially a veteran could purchase a home with no money down, up to $1 million plus in total loan amount. And then the next product is a USDA home loan. Those are going to be more popular in our kind of more rural areas. USDA, which stands for the United States Department of Agriculture, as you would expect, provides a guarantee for those buyers that want to purchase in more rural areas. There's two major requirements to the USDA product. One is it has to be deemed a USDA qualified area, and two is you have to meet income limits based upon your household size. And then finally, there's the jumbo loan. And jumbo loans allow buyers to have a little bit more financing backing for those higher purchase price amounts. The difference between a jumbo loan and, let's say, a conventional loan is really around the amount of down payment or assets that I'll need to have. Generally, for a jumbo loan, I need at least 10 to 15% down payment, slightly higher credit score requirements up to about 680 or higher. And there's another component to the assets, which includes reserves, which essentially means how much money do I have left over after I've contributed my down payment and my closing costs. Now, one of the things that comes up around loan programs in our discussion with clients is the discussion around PMI or private mortgage insurance. So what we like to do in our classes is to talk about, like, how does PMI and FHA mortgage insurance weave into our home buying scenarios? So we're going to do a quick little comparison around conventional loans versus FHA loans centered around mortgage insurance. And I will say, for those of you that have already started your home search on, Zillow or Redfin, you may have taken advantage of using their calculator functions, which is fantastic. But what you'll find is the mortgage insurance doesn't necessarily add up correctly with those calculators. And the reason why that is because there's different characteristics that go into PMI mortgage insurance versus maybe what you'll see in just an online calculator. So let's talk a little bit about it. So PMI comes into play on a conventional loan when I put less than 20% down to purchase my home. Now, there are various payment options on how to take on PMI. You can do it on a monthly basis. You can split the mortgage insurance up where you pay some of it monthly, some of it upfront. You can also do a single premium option, which essentially means you're buying out the mortgage insurance as part of your closing costs. Not a super popular option, nor is the split MI. And then there's the lender paid mortgage insurance, where essentially I'm taking an elevated interest rate in order to buy out my mortgage insurance. By far, the most popular option is monthly mortgage insurance. And the reason for that is because mortgage insurance on the conventional side of things has a cancellation option. So essentially, when I achieve at least 20 to 22% equity on my home, and I have 2 years in my home in terms of how long I've had that loan for, then I can apply for a cancellation option with my loan servicer without having to refinance. So that makes it a pretty popular option. Now, I mentioned earlier about the calculations on mortgage insurance when you use some of those online calculators, and here's the difference. So when you calculate out PMI, it takes into consideration credit score, down payment, and then how much you decide to finance. So most of the calculators online are just kind of a one size fits all. But when you kind of boil it down to those characteristics, you may have a much cheaper premium. So mortgage insurance shouldn't feel as penalizing as you might wonder. Now, if we were to look at an example of PMI, you can see at the bottom of the screen, let's say we financed $450,000. We had a 740 credit score, and I'm putting down 3% in down payment. Well, my PMI is probably about $183 a month. Okay, so you may see that same calculation online and think, wow, it's going to be $300 a month. Not necessarily the case, especially for our higher credit score customers. Now let's kind of switch gears and talk about FHA mortgage insurance. So FHA is government insured mortgage insurance. There's two forms of mortgage insurance. There's monthly mortgage insurance, which is generally 0.55% of my loan amount. And then there's also upfront mortgage insurance with FHA loans. And so upfront mortgage insurance on an FHA loan is 1.75% of the total loan amount, and it gets baked into your total amount finance. Now, with FHA mortgage insurance, it cannot be canceled through any type of equity appreciation like you see on the conventional side. It only can be canceled on a refinance. Now, if we were to look at the same kind of various scenario, like a 450 loan amount, and let's say my credit score is at 740 on an FHA loan, or maybe even 640, well, that's not going to change my PMI calculation for FHA because it still will be the standard 0.55%, which would be $206 a month. And then I'd still have upfront mortgage insurance, which is $78.75. So, when you kind of put a side-by-side comparison with both of those PMI options, clearly the conventional loan is going to be a little bit cheaper, but I think it's important to understand as future buyers is, not all clients will qualify in conventional loans. So FHA can be a wonderful kind of other option for us in achieving home ownership and give us that flexibility that perhaps we need in underwriting guidelines. Now, we had a question that came in Q&A, which is, what does PMI stand for? So again, PMI stands for private mortgage insurance. So essentially, there's private PMI companies out there that will essentially back these loans. Essentially, PMI is ultimately providing insurance coverage to the lender. So if there was a default situation where someone maybe just couldn't pay their payments and there was a default, well, the lender would be protected against that. On the FHA side, it's government-backed mortgage insurance. So essentially, the Federal Housing Administration is coming in and saying, we're going to back that loan because you're doing an FHA loan. So good question. All right, let's talk really quickly about income as it relates to home buying and kind of documentation. Pretty simple here. As we're kind of thinking about preparing for home ownership, I always like to give our audience things that they want to think about gathering documentation wise. So if I'm a W-2 employee, like I work for an employer, I generally need the last 2 years of W-2s, recent pay stubs. And then throughout the course of the process, we do a verification of employment. So that kind of occurs once we have an accepted offer for a seller. If I'm self-employed, maybe a little more documentation needed, especially like the last 2 years of tax returns, usually some type of profit and loss statement. And then we verify kind of where the state of the business is with like a CPA letter. Now, one of the things I like to cover in this section is just to talk a little bit about employment or income scenarios. I work with clients all across the country, and there's obviously a variety of different scenarios that come at us. So I want to share with our audience a few of those scenarios that might be helpful for you on this journey. One is around how long do I have to be on the job? And so in lending, we do require us to be able to verify 2 years of work or educational history. So what does that mean? Well, let's say I graduated from UVA fall of 24, right? And I just started my job January 2025. Well, if I can show my educational history and then plus my new work that I'm starting, I meet that 2-year requirement. Okay. I don't necessarily have to be on the job for 2 years. I could be switching jobs. I could be, in a position where I just accepted a new offer for a job. All those things can be factored into qualifying for home financing. Where a 2-year requirement gets a little bit more tricky is that if I have dual employment, we see this sometime in the healthcare industry, where maybe I'm working at 2 different clinics on a weekly basis. Maybe I split my time up at 30 at one, 30 hours at one, 20 hours at the other. In that case, I do have to show that I've been working at both clinics simultaneously for 2 years. And if I'm self-employed, then I do have to show that I have 2 years of consecutive filed tax returns so we can get an assessment of the business to do our income calculations. One other question I just want to or one of the things I want to just point out to you, some of our clients, that have variable compensation plans, like let's say I have a base salary of X, but I have a bonus program or I have restricted stock in my comp plan. The restricted stock could be potentially used as income sources depending on how long you've been with the organization. Bonuses can be used or commissions can be used as long as I've been on the job for 2 years. And then essentially we average out the 2 years of income. All right. Well, as we take income into consideration, we also look at expenses. And there's a calculation that we use in financing called debt to income ratio. Essentially takes those expenses like your new housing expense, credit cards, personal loans, auto financing, student loans, whatever the case may be, most things that appear on my credit report, and I take that compared to my pre-tax income. Generally speaking, we don't want those expenses to exceed more than 45% of my pre-tax income. So for example, let's say I have a new housing payment, you can see on screen here. Let's say I have a housing payment of $2,500 a month, which would include principal and interest of my new mortgage, the property taxes I'm going to pay on my house, the homeowner's insurance I'm going to pay, plus PMI. Maybe I have a homeowners association because I bought a condo or a townhouse. Let's say that's $2,500 a month. And then my other expenditures are $500 a month. So essentially my expenses outgoing would be $3,000. And then if my income is $8,500 a month, then essentially my debt to income ratio is 35.29%. In lending, we really don't want that number to be higher than 45 to as high as 50%. The question I get from a lot of prospective home buyers is like, where should it be? Well, normally I'd see the sweet spot or comfort zone for most first-time buyers being around 33 to 36%. The question we're going to have during our conversation, I should say, we're going to have during our consultation with you is like, what does affordability look like for you? Because affordability is so much more important than just a metric to qualifying. So we want to make sure that, we create a home buying plan that essentially is going to allow you to have sustainable, a budget in your home, and ultimately have that be able to be affordable over the course of time. All right. So a question in the Q&A before we talk a little bit about assets was around HOAs. Are they worth it? I don't know if it's necessarily a question of are they worth it or not. It's just, are you going to purchase in a community that has an HOA? So if you're looking at a condominium, a townhouse, you're going to have an HOA. Some single family communities will have that. So if you have a community that has a gym or something, or a community pool, there'll probably be an HOA assessed with that. It really just depends on how much value you think you'll get out of those community investments, so to speak. So, but for condominiums and townhouses, yeah, we'll definitely see an HOA. As a side note, because it is a hot topic for lending right now, if you're considering condominiums, as a lender, we do have to go through and do some kind of due diligence, so to speak, on the HOA. Because when you purchase in a condominium, for example, you're not just buying unit 100 that's yours, you're actually buying into the entire community. So if you're buying a condominium and there's 50 total units in the community, you're going to own one of those units. Well, when you purchase into a condo community, you have kind of vested interest in the community in terms of common areas, the financial health of the HOA that's running your organization or your community. You want to make sure there's no legacy, litigation going on in the community. So when you purchase a condominium, we do all that kind of background work for you to ensure you're buying into a community that's in a good financial position and, free of any health or safety issues for you as a potential owner. And that can be an issue right now because not all HOAs are in really great position. So we have to make sure that, you're buying smart from that perspective too. All right, let's talk a little bit about savings or assets that we prepare for home ownership. As I mentioned earlier in our discussion, like those are, assets or savings can be one of those two challenges that we have beyond credit. But let's talk a little bit about what we should think about preparing in terms of documentation for home ownership. So, if I'm going to use my checking or savings account, generally we need the last 60 days of statements. You can potentially leverage 401ks, 403bs, even IRAs. I would encourage you to talk to your plan administrator or your financial advisor before you access those assets. Even family can contribute towards your home purchase. We call those gift funds. That essentially is where a family member is contributing funds to your home purchase. There is no seasoning requirement to those types of assets. A family member can contribute right away. But other assets like checking and savings accounts, any of those 401ks or 403bs, those all need to be at least seasoned 60 days. Okay. Now, I want to give you kind of a tip or like a kind of a way of kind of managing savings for yourself. And again, as we talked about and we launched in today's class, starting these conversations at the beginning of the year is, I think, hopefully helpful for you. But around a savings plan can be, really, really important for you. And so, as I meet with clients and maybe we're not quite at a certain savings level to begin home ownership, we talk about building these plans. And it's a really simple approach, but here's kind of what I would encourage you to do. And so let's take our example earlier today where we looked at a scenario where we're paying $2,500 a month in rent, right? So if I'm paying $2,500 a month, but I'm just lacking a little bit of savings right now, but I know my cash flow is going to be pretty good because I got a new job, things are going pretty well. I just haven't got a chance to save over the last couple of years. Let's say I think with my cash flow, I can get to maybe a $4,000 mortgage payment, right? That's great. But maybe since I lack the savings, what I would encourage a buyer to do is start saving like you're making a $4,000 mortgage payment today. So when I make my rent payment on the first of the month, I have $2,500 that goes to my landlord, of course, but I have $1,500 left over. We create that discipline for ourselves that $1,500 just automatically transfers to our savings account. And before we know it, by the end of 6 months, we're up to what, $9,000 in additional assets that are available to us. By the end of the year, it's $18,000, not including interest. So I think there's a huge opportunity to create those disciplines early on as we start the year on savings habits, if you will. And of course, that doesn't go beyond saying, then it also comes down to budget too, right? So if we're going to look at setting our budget for this year, our entertainment expense, housing expense, how much we're allocating to credit cards and student loans, our travel expense, all those things, if we can kind of squeeze our budget a little bit, hopefully a little bit of cash flow will come out of those disciplines that can create more savings for yourself as well. I'm going to answer one more question before we talk a little bit about first-time buyer programs, which will be a resource for you in your market. But the question is, generally, is it better to put away in the savings or pay your debts down? It just depends on where you're at and kind of how you're handling existing debts and what the interest costs are on those debts. Those are conversations that I encourage clients to have with us during a consultation. And it depends on where you're at currently with your assets, right? So if you have a $20,000 in savings, well, that might be enough to get you into home ownership. And so maybe we need to start bringing down debts because those minimum monthly payments are impacting your budget on the home ownership side. So probably a little bit more complex of an answer that we can certainly tackle during a consultation. Let's talk a little bit about first-time buyer programs. We're going to spotlight Virginia because obviously we're hosting a Virginia class, but I do know looking at the chat, everybody's all across the country. So since we don't have a lot of time left in class, I would encourage you get connected with me for a conversation after tonight's class. Let's see if there's any first-time buyer programs that can match up for you. The first program available is the Virginia Housing Program. And by the way, in every state across the country, there generally is a housing agency that helps support low to moderate income households in homeownership. Virginia obviously is no exception. So the Virginia Housing Conventional Loan will give a client, say, more flexible down payment options. You can also couple that with a second mortgage product that we have for the Virginia Housing product. And it's ultimately going to kind of decrease the cash out of pocket. There's also a down payment assistance grant that can allow you to borrow 2 to 2.5% of the purchase price. When you have a grant, it doesn't have to get repaid, which is great. But there's also products where you can borrow, depending on your income eligibility, where you can also borrow 3 to 5% of your purchase price. Use that towards contributing towards your down payment and closing costs. That would be something that be repaid generally once you either sell the home or if you decide to refinance in the future. Before we go into the buying process, as we're kind of getting towards the latter part of class, I just wanted to point out we do have a new product that just launched with our team that's a nationwide first-time buyer program. It is specific for the FHA loan product, but it will allow someone to be able to borrow 3.5%, which is 3.5%, which is the minimum down payment for an FHA loan, up to 5% towards, to be able to complement for their closing costs. That's called our Pathway product. That's something we don't have in today's slideshow, but we can certainly send along some resources for you if you're interested in that. That's a nationwide product, so it's not specific by state. All right, well, let's talk a little bit about the 6 steps of home buying. This is our kind of path towards home ownership. It's our milestones in the process of buying. As we started tonight's class, pleased to announce that we had several UVA alum purchase with us in 2024. Whether I guess we had most of actually everyone that purchased with us was in the state of Virginia last year. But seeing our audience today, hopefully we're going to be helping buyers in New York and Tennessee and California, all across the country. So really excited to support you on this journey. But here's what it looks like. Step 1 is going to be your pre-approval. And you may have heard about that in your searches, but essentially a pre-approval is the output of a consultation with us. So it gives us like the framework of the financing. It's ultimately a letter or certificate that you present to a seller when you're planning to make an offer on a home. It's usually good for 60 days, but it can be recertified at any time. So our applications stay active for 2 years for our buyers. And so pre-approvals get updated over the course of those 2 years, but it can be easily recertified over time. So again, that kind of gets us out of the consultation to pre-approval. And then once we're pre-approved, then we start actively home shopping. It could be just starting online. And then once we identify 3, 4, maybe 5 homes that we like, maybe we hop in the car and start looking at places in person. We always encourage our buyers to connect with a realtor. Realtors should be experts in their market. They should have resources available to them to be able to see, how walkable is this community? What's the school district look like? Maybe all those important characteristics you need to see in a particular community. Now, the laws around how realtors are compensated has changed a little bit. We'd encourage when you do talk to a realtor, ask them a little bit of questions about that. But ultimately, the National Association of Realtors settled a lawsuit that essentially changed the way in which they're compensated as they represent buyers. So it was always assumed that a seller would pay the commissions to a buyer's agent. That has changed, where a buyer's agent has to have an agreement with a buyer on how they're compensated, and ultimately their compensation or commissions are negotiated into the contract. So I wouldn't consider myself an expert on that, but I would encourage you, as you get further on down the path towards homeownership, ask some questions of your realtors. And we have some really great preferred realtors in our network that we can introduce you to when needed. Now, as we move to the 3rd step, that is going to be upon accepting an offer from a seller. A seller has essentially accepted your offer, or we have a ratified contract for a home. That starts the kind of the real process. It'll be taking us through steps 3 through 6. Essentially, when an offer has been accepted, that means now it's kind of go time, so to speak. Within 24 hours of that accepted offer, you're going to get a call from me saying, congratulations, here's what we got. Let's talk a little bit about next steps, and then schedule you for a follow-up video session. That's where you and I meet for a one-on-one session, just to make sure we have all the financing built correctly. And then we have you kind of work through an action items list to get us prepared for underwriting. Now, within a couple of days of that accepted offer, you'll be required to make an earnest money deposit, which is generally in most markets 1 to 2% of your purchase price. Those funds will count towards your total out-of-pocket expense for your home purchase. And when we think about total out-of-pocket, we're considering down payment, closing costs for our home purchase. Now, in most markets, inside of that purchase contract that you sign will be some timelines for contingencies, which will allow you to basically do some investigative work on your home. So your offer is essentially contingent on certain things occurring, like getting your house appraised to make sure the house is worth what you're buying it for, getting the house inspected to make sure everything's in good working order, and finally, getting your loan approved to make sure all the financing is in place. We shouldn't be too far along without having the financing in place. There won't be any surprises for you in that process, but we want to make sure we kind of have all the boxes checked before we give the seller the okay that, hey, your contingency looks great. Step 4 is going to be the processing of the loan. That includes the underwriting, a lot of the administrative tasks that we do on the financing side. One question comes up often is, when is my interest rate lock secured? Once you have an accepted offer with the seller, so at step 3, then we'll start talking about interest rate locks, and you're eligible to lock in your rate at that time. However, there is some strategy to locking in interest rates in a timely manner, because markets for interest rates change by the minute. So as the trading day happens on Wall Street, markets change with interest rates. And so those are conversations we have as we start the process on how we want to look at the market. Do we want to lock in the interest rate right away? Do we perhaps want to do what we call is float the interest rate, because maybe some economic news may come out that helps improve interest rates? And that's part of the kind of strategy that we go through during the home buying process once we're under contract with the seller. And then as we're kind of rounding to the finish line, we talk about step 5, which is the loan approval. That means an underwriter has issued an approval on our loan. Also takes us to the end of the contingency timeline. So if everything kind of checks out for the financing, the appraisal, and inspections, then we can sign off on that contingency. It also, as a lender, has us deliver to you a final closing disclosure, which essentially gives you a 3-day cooling off period before we get to the very final milestone called the closing of the home loan. And throughout the process, you'll be given disclosures sent to you electronically. There's initial disclosures that go out to you within 72 hours of your contract. There's other disclosures once your interest rate is locked. And then finally, the final closing disclosure once we get within 3 days of closing. Now, at the closing of the loan, at step 6, we're essentially signing loan documents with the escrow officer or attorney, depending on what state you're in. Also, at that time, we'll wire in the final funds that we have as buyers that are still needed to close the transaction. And then as a lender, we then wire in your financing funds and maybe the assistance program if you elect some of those products. That money gets all reconciled by the title/escrow team, and then documents get recorded with the local county recorder's office. They generally record a grant deed, which transfers ownership to you, and then the deed, which is essentially the loan. And once everything gets confirmed with the recorder's office, then we get a chance to make our favorite call of the day. I made a couple of them this morning, which is to say, hey, congratulations, you're now the new homeowner. And that's the best part of my day by far, next to teaching classes like this, of course. But it's a huge accomplishment for you. And we want to be there to celebrate. We always send closing or housewarming gifts to our clients because it's a big deal. And again, as I mentioned earlier, we've had several UVA alum who have attended classes just like this in 2024 are now sitting in their new homes, happy as homeowners. And so if you're thinking about moving forward in the process and want to just build a plan for yourself, you don't have to necessarily be buying this year. Whether it's in next year goal or beyond, we want to just be a partner for you in homeownership. It starts with a real simple 3-step process. There's an online application to just kind of get some information from you financially. You upload documents. We only do a soft credit check, so that's important because we're not going to impact your credit score at all. And then you'll schedule through our system a video consultation. That's a one-on-one with me to design your home buying plan. And we're going to talk a lot about things like we've already reviewed in tonight's class, but just want to make sure we solidify a really good home buying plan for you and then essentially issue that pre-approval for you. Now, you may have some questions specific about your own finances. Maybe it's a credit question or savings questions. If you want to, and you're not quite ready to take that consultation leap, schedule an introductory call with us. That's a great way of just kind of getting to know us a little bit more and see how we can answer some of your questions for you. This is what that consultation framework is going to look like. I can't emphasize this more. It's a free consultation, so take advantage of it. It's the opportunity for us to help you on that journey towards homeownership. But we have a variety of different topics we're going to discuss during that session. And we do it all over video because we want to screen share all of this information with you so you can get a chance to see how we can kind of customize that home buying plan for you. Well, we have some great resources for you available on mobile as well, available through Android and Apple. That's our APM mobile app. You can start your application right there. You can do some calculations that are reasonable calculations or viable calculations right there. You can also kind of follow the progress of your loan once you're submitted your application. You can follow that all through mobile. As we wrap up today, I just want to tell you how proud I am to get a chance to present to our UVA alum this class. Again, we got a chance to do it last year and really proud of the attendance and just being able to be grateful to be able to support you guys on this path. We have other partnerships that are available across the country too, and these classes are accessible nationwide. So if you have friends, family, coworkers that think would really kind of use this information or find this really, really useful for them, feel free to have them check us out at mortgageeducate.com. We have a list of all of our classes. We'll be teaching over 50 classes this year to 10,000 future home buyers this year. So really excited about that. That's a big goal for us this year to just help really invest in our local communities. Here's all my contact information. So if you do have questions, don't hesitate to shoot me a call or drop me a text. And that brings us to the end of tonight's class. I appreciate everybody kind of working through our technical issues. Of course, that go figure, that's the first class of 2025. I appreciate you guys kind of working through that. I see a few questions coming in the chat. Yes, we're going to send out the presentation for you. This is being recorded, so it will be up on our YouTube channel tomorrow, and we'll send out that PowerPoint to you as well. Well, I'm going to hang out for a few more minutes. If you do have any questions, feel free to put those in the chat, Q&A, whatever's good for you. I want to make sure I didn't miss anything from our audience here. Okay, and thank you. A lot of great positive feedback in the chat. Thank you so much for that. I appreciate you taking time. I know not the most exciting thing to listen to finances on a Tuesday night, but I appreciate everybody attending. All right, thank you for that. Cool. Okay, I think let me just make sure I got us all. So I had one question, if everybody's still kind of tuning in the chat here, which is, assuming you can pay the 20% down payment and closing costs, is there any reason to not do so? And I would say for the most part, I would say go for it. I think that's probably a good idea. But let's strategize a little bit about that, because maybe we have some upcoming projects we want to save for. Maybe this is a property that needs a little bit of investment or TLC to get it up to your standards. So you may not want to liquidate a lot of cash if you want to kind of preserve some of that. So those are things we just need to kind of talk through a little bit. And then another question was, I'm on L1A visa and currently in the process for a green card. Any thoughts on that? Off the top of my head, I just got to double check that L1A visa qualifies under Fannie Mae or FHA. Let me just circle back with you on that. And I will pull the Fannie Mae guidelines and then just message you directly on that. If you can, we'll put that out to the group here, because I think we have you. I have your name here, and I think we have your email address. So I'll double check that on the Fannie Mae guidelines. L1A just doesn't come off the top of my head, so I want to double check that for you. All right, and you are welcome. All right, I think we did it. All right, everyone. Well, I think I'm probably holding you up for your dinner, depending on what time zone you're in. So thank you so much for attending tonight's class. Look forward to connecting with each and every one of you for hopefully your upcoming consultation and help you on this journey towards homeownership. Have a wonderful evening. Good night.